everyone, welcome to the special segment called as MC Pro Select Stock of the Day. I'm your host, Nikki Minchinani, and in this segment, we bring to you fundamentally strong investment stock ideas. Well, today we're going to be talking about ICICI Bank, clearly the stock of the day, where it is the second largest private bank with advances exceeding around 11 lakh crore as of end of September, has demonstrated strong performance, has notably outperformed its peers, that is HDFC Bank, in terms of the stock returns. This solid performance has led to ICICI Bank trading at a premium valuation compared to that of HDFC Bank. Now, why does MC Pro really like ICICI Bank? A couple of reasons there for you. We'll address the first one, which is the strong growth in advances. ICICI Bank has been consistently gaining market share, with its overall advances growing by an impressive 21% year on year as of end of September. Retail loans now make up to 54% of the bank's loan book and are growing steadily. Additionally, unsecured credit, including personal loans and credit cards, has shown solid growth, constituting 13.3% of the overall loan book. Looking ahead, credit growth is only expected to remain healthy in the financial year FY24, supported by growth across various business segments. Notably, deposit growth is in line with advances growth, reflecting a balanced and sustainable financial position of the bank. Let's understand the second factor here, which is best-in-class margins. In Q2 FY24, ICICI Bank's margin declined, and this decline is expected to moderate further in the next quarter. However, the bank's management is confident in its ability to maintain the margin for FY24 at the FY23 level of around 4.5%. Despite the compression in margins, ICICI Bank is positioned to deliver the best-in-class margins for the ongoing financial year. Asset quality also is best in a period of a decade. Third factor there for you, ICICI Bank has been experiencing a positive trend with its gross and net non-performing asset ratio, that is GNPA and NNPA, steadily decreasing. As a result, the credit cost has declined to its lowest level at 0.2% in Q2 FY24. The bank has substantial total contingent provision of roughly around 13,100 crore, which is equivalent to 1.2% of its overall loan book. With a provision coverage ratio of nearly 83% and the provision buffer, ICICI Bank seems well prepared to support its future earning growth profile. Let's understand the last factor, which is profitability and attractive valuation. In the Q2 of FY24, ICICI Bank achieved impressive financial metric with return on assets ROA at 2.4% and return on equity of around 19%. The bank's solid top-line growth, driven by net interest income and a higher provision coverage ratio (PCR), provides a strong foundation for the future earnings. Now, furthermore, the stock is currently trading at 2 times the core book value, that is adjusted for subsidies, estimated for FY25, making it an attractive investment bet. Although earnings stabilize, the growth may stabilize, the stock potential for growth is only expected to come from an expansion in its valuation multiple, that is re-rating. Well, in terms of key risk that we have for this one, slowdown in credit offtake, sharp fall in margins, higher slippages in unsecured loan, and adverse macroeconomic environment conditions, if any. With this, it's a wrap. Thank you so much for tuning in.